Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. Well, a working group at the RBI has recommended a series of changes that could transform the country's banking landscape by paving the way for large industrial conglomerates to set up banks. The proposals could also allow large non-banking finance companies and niche payment banks to convert into lenders. In a report made public on Friday, the committee recommended that banking regulations be amended to allow large industrial houses to act as so-called bank promoters, meaning they could take a significant stake in a lender, something the central bank has strongly resisted in the past. As well as opening up the banking sector, the committee suggested adjusting the size of the stakes of major stakeholders can hold in a lender. For investors not involved with the bank at the outset or non-promoter shareholders, a uniform cap of 15% instead of the current tiered structure was suggested by the committee, which was formed in June to review ownership guidelines and the corporate structure of Indian private sector banks. It recommended increasing the size of the stake that promoters in private banks can hold to 26% from the current 15% over a 15-year time frame. In this edition of The Big Picture, we will analyze the recommendations of the RBI. Joining me on the program today are Siddharth, National Economic Editor, Times of India; Ajay Shankar, former Secretary, DIPP, Ministry of Commerce and Industry, Government of India; and P. Pullarao, economist. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Shankar, let me begin the program with you first. Let's first try and understand and analyze these recommendations that have been made by the RBI. What do you make of them?
I think they are a very sensible response to the demands of the current situation. See, regulators have a challenge of arriving at the right point in the regulatory spectrum where they support economic activity, and it's always a tough call. So right now, the regulator is reacting to a few developments over the last many quarters. One is that the large NBFCs were found to be very lightly regulated, and some of them ended up by getting into difficulties and posing a systemic risk to the financial sector. So the regulatory response has to be in increasing regulation, but not over-regulating so that they don't have the flexibility to serve the needs of a dynamic economy, which they were doing well till some NBFCs went into difficulty. The route of allowing the larger NBFCs into becoming a bank is a way of making sure that the large NBFCs who are too large or too big to fail come into a tighter regulatory regime, which is what is there for banks. So it addresses the problem of basically giving a route to the large NBFCs who are too big to fail to convert themselves into a bank. And if you're very large, there are also advantages in being a bank. As far as the promoters being industrial houses are concerned, I think this was an anxiety which the RBI had earlier, and it flew from the history of the Indian banking sector. But I think they're moving in the right direction because what is material is effective supervision, oversight, and regulation by the RBI, rather than the promoters' stake in equity in the bank. So it's the management and governance which is important, not who owns how much equity. And if you look at our two most successful private banks, the HDFC and ICICI, they have a lot of foreign equity in it. So if you're comfortable with foreign equity in a well-governed, well-regulated, well-supervised bank, I don't think we should be too apprehensive about industrial houses having some equity in a bank, as long as the regulation is well done. And one other point which I think I would like to also emphasize is that there is a case for the light-handed regulation of NBFCs continuing, but regulation on regular banks becoming much tougher, because at the end of the day, the average depositor expects all his deposits to be fully secured. And politically, I think governments will have to step in to save every depositor. So if the regulator is much tighter, if a depositor has to pay some insurance for large deposits, I think that is the way to go forward. But a tighter regulation of banks to make sure that they don't fail, I think is also the necessity of the times.
Absolutely. All right, we'll talk about regulation and whether how much of regulation is good regulation as well. I'll just come to that in a bit. But before that, Dr. Pullarao, so does this now make I mean, if of course implemented, there have to be a few changes to the law as well. So if eventually done, do you believe that the role of the regulator is going to be a little more challenging, more difficult, and the regulator also has to be a little more nimble going forward?
Absolutely. I think we have been very conservative in expanding the banking sector. We only have been looking at the urban sector and the banking needs. And it's very welcome what the RBI and the government is now doing. We have to expand the banking sector. If you want a $5 trillion economy, if you want to keep on, forgetting this COVID period, if you want to get back, there's a vast underbanking situation in the country. And the large private banks, as of now, they're financing in a very limited way a vast section of people. Do we need more banks? Yes, we need more banks. Do we have to ensure that these banks don't fail, spectacular failures in some ways? Yes. How are other countries doing it? And we have to go into all of this. There should be more regulation. But I also feel that the RBI, or if you require a new entity, should be more liberal in allowing banks to come up. I believe, there are so many other descriptions I have given. Small finance bank, which is very useful, very targeting of certain audiences, talking of certain stakeholders who have no banking, no access to banking. If you remove the cooperative banking in the rural areas, then there's absolutely no banking. Therefore, I very much welcome, yes, these are small steps, very small steps I view them. And along with banking, if you expand the banking sector, naturally, the public also will benefit. This.
Right. Absolutely. And that's the goal at the end of the day. The public has to benefit, and we have to have a robust banking system in place, build on the foundation that we already have. All right, Siddharth, let me come across to you now. So as far as regulation is concerned, how much of regulation is really required? How much of regulation is too much? What constitutes over-regulation? How do we look at these aspects?
I think you can criticize RBI for a lot of things, but regulation is something that you can't criticize them for, and supervision as well. So we have the regulations, and if at all the complaint is that there is over-regulation in terms of getting banks to do various sorts of things which in normal course of business they wouldn't do. And also in terms of the SLR and the CRR kind of things. So regulation-wise, RBI is one of the best regulators that we have in the country, and globally also they are rated very highly. And in terms of supervision, what they do is that they inspect the books every year, they inspect the branches, the functioning of banks every year, and the problem where arises is that at times the follow-up in terms of supervision is missing. For instance, in case of ILFS, there were red flags which were raised during the whole inspection and the supervision exercise, but at some point of time, the action was missing. The other thing is that if you look at but RBI has emerged as wiser from this whole experience. So after the ILFS crisis, what it has done is that it is very closely monitoring the top 50 or top 100 NBFCs, and wherever required, they're getting the promoters and the shareholders to get in more capital so that there is enough capital and there is no crisis in the sector. Because, and also in terms of the way banking is done in India is a lot different that between RBI and the government. Banks are not allowed to collapse because of two reasons. One is the whole issue of protection of depositors, and two, in terms of a systemic issue that may arise. Even a smallest bank, if it goes down, can create ripples across the system, and or for that matter, even an NBFC. So the government and the RBI have traditionally stepped in to protect bank failures.
Absolutely. All right, taking the discussion forward now, and since we raised the point of NBFC as well, so Mr. Shankar, as far as NBFCs are concerned, what does it mean? Because in the past, we've seen that NBFCs have struggled, gone through a rough phase. What does this mean for smaller banks and for NBFCs?
I think a little bit of perspective in this is called for, because in a market economy, it is natural for a relationship with one customer to go wrong. A customer can default. It is possible for the lender to have internal governance problems and things can go wrong. It is possible for a class of customers to go wrong because of a structural problem, say as happened in the housing and real estate sector. Or we can have an extreme situation where the whole economy is collapsing as it has been for the last 2 quarters. So one should not move towards a regulation for the worst case scenario when we are not in the worst case scenario. So some nimbleness and flexibility is required, and notwithstanding the failures, including that of ILFS, the NBFC sector has served the Indian economy very well because it has taken credit to categories of consumers who wouldn't have got it. They've had focus in sectors which banks would have found it difficult to serve in that manner. They've also been flexible enough, and the light-handed regulation of NBFCs was good. So what the RBI now doing is a little modest course correction, that if you're too big to fail, or you will cause systemic problems, then we will regulate you a little more or supervise you some more, encourage some of you to become banks. And hopefully it is not going to overdo the regulation bit going forward for the NBFCs. And we do need NBFCs. Yes, some of the large ones becoming banks is a good idea. And within NBFCs, they have improved the supervisory and regulatory mechanisms, but so far I think they've not overdone it, and which is good. It is also very heartening is that they moved very quickly to the rescue of NBFCs in the early days of the serious crisis caused by the COVID lockdown. So on the whole, I think we are on track, and I think the RBI, I agree with the earlier panelists that I think we can trust the RBI sufficiently. But one point I would again like to reiterate, that I think it's time to take a clear policy decision that every bank deposit is fully secured. That's not the international norm or practice. I think we need to depart from it. And if they're very big depositors who are, say, putting a crore in FDs, etc., they should pay some insurance for it. But I think we need a banking system where all deposits are fully secure to give enough confidence to the retail saver and to the entire economy.
I think that's a great proposal. I think if someone is putting in so much money, I think they can take in some kind of insurance and we can move forward in that way so that the money is safe as well. Let's see if that suggestion is taken as well, because the RBI has said that recommendations are open till Jan 2021. So probably this could be one of those recommendations as well. All right, taking the discussion forward now. So since COVID was brought up, since the pandemic was brought up, Dr. Pullarao, how much of an impact has the COVID-19 pandemic had on the banking sector as a whole, and has irreparable damage been done?
First of all, I don't think no irreparable damage has been done, because government on court orders and other issues has come forward, helped in this credit, VMI changes and all these consumer credit. Government has been active, government has been alert, at least in the last 3-4 months. Therefore, this will revive. The banking sector will revive. And I don't think this COVID has set back for some time. And particularly when you find banking has been distant. Now we found from these migrants, crores of people who got into the banking habit, who were getting money, they have now been disconnected. That connection will have to revive. Banks and government will have to be a little charitable, writing off things, doing other things to get them back into the banking sector. COVID has been an unusual phenomenon, and we have not seen any bank failures to that extent because of COVID, because of all these safeguards taken. But to revive the linkage between those marginal people who were thrown away due to COVID, government will have to take extra steps. RBI will have to take extra steps, because it's very important that things get back to normal. If your economy is going to revive again another 6 months, 8 months, those sectors who were affected could not pay. All the sectors, small sector, medium sector, they should get some relief. And government should take particular care, or the RBI should take particular care. These unvoiced marginal sectors, they don't have chambers of commerce and other big groups to represent them and get what they need. There has to be an eye-opening activity there, and you have to attend to that. Otherwise, they'll be permanently, this poverty will go on that way. So there is a need for government opening up to these sectors. And COVID has affected them, and they have resorted to private money lending. If you read all the reports coming in from various places where the labor went back, where factories are closed, where the transport sector is closed, that has to be definitely looked into so that some sections are not left out. They have to be brought back into the sector, and this sector also has to open more widely. The small banking structure, whereby niche stakeholders, people who need money, marginalized sectors, farmers, and other people also get it. So along with these reforms, which government is considering, you have to consider the marginalized sectors who have been affected during COVID and even who are not covered earlier. So I personally look forward that this is a period of reform and RBI will be a little more proactive in these issues.
Absolutely. All right. We'll talk about what more needs to be done and how much more can be done as far as the banking sector is concerned a little ahead in the program. But before that, Siddharth, as far as the NBFCs that are primed to become banks are concerned, are there certain NBFCs that are front runners? And as far as, industrial houses too, who can take up banking, are there any front runners on that front?
See, I think we've expected RBI to allow the corporate houses to come into the banking sector, and RBI has a lot of reluctance. There are at least a couple of business houses, Tatas and Birlas, which have in today's papers said that they are looking at the regulations and they may be interested. I mean, the Aditya Birla Group has a very large financial services business, and so does the Tata Group. So these are two business houses that immediately come to mind. There are some large NBFCs such as Shri Ram Capital or Bajaj Finserv, and people like them in the NBFC space who would be interested. Apart from that, there would be entities like Ireland like India Bulls, which may be interested. But having said all this, the proof of the pudding is in eating it. So this is just a recommendation of a committee. There is there's a large stakeholder consultation which is still awaited. The government has to be fully on board. The RBI has to be first convinced about the need to allow NBFCs and banks and large companies to get into the banking space. Getting large companies, corporate houses back is something which is like going back 50 years when this whole nationalization started. There were corporate houses which have set up banks in this country. Some of them are still, there in some form or the other. So it's a very, very, the suggestions are quite radical, but I don't know if the RBI and the government are, ready to accept them in this form or not. But yes, it does set the tone that maybe not immediately, then maybe 2 years, 3 years down the line, there would be some change for sure.
Absolutely. All right. So let's broaden the scope of the discussion a little bit and look at the banking sector as a whole. Mr. Shankar, a lot of reforms have already taken place over the last few years as far as banking in the country is concerned. How have we fared really as far as these reforms are concerned? And do you believe that more needs to be done?
I think the reforms have been in the right direction. The RBI has certainly improved supervision, which was a weakness, because if supervision had been good, then the difficulties that a couple of banks have had may not have occurred. But going forward, the first point I would make is what I'd made earlier, that I think at our stage of development, every depositor in a bank should feel all his deposits are secure. If he has to pay an insurance premium for it, he should be asked to pay it, and he would gladly pay it. And those who are willing to take risks can go to NBFCs, can go to mutual funds, stock markets, etc., which should remain unsecure and provide greater dynamism in the economy. But the other thing which the banks, I think, need to do, and which needs to be addressed as we start recovering from the COVID crisis, is that in some ways we've kicked the NPA problem can down the road. So we've given moratoria, we've extended the period of moratorium. We've said the IBC or the bankruptcy proceedings are kept in abeyance, which are all very sensible measures. But we must recognize that once things ease, then this problem which has been brushed under the carpet will surface. And at that stage, I think some more creative and flexible decisions would need to be taken, firm by firm or borrower by borrower, and including for classes of borrowers. So the Kamath Committee has recommended restructuring during the period of the lockdown or slowdown. But once things are back to normal, my suspicion is that in many cases, some additional restructuring of existing debts may be required. Similarly, when all the government guaranteed loans to the MSME sectors become due for repayment, again, some view would need to be taken, whether they need to be restructured, whether some haircuts need to be taken to make the firm survive. Because if one takes an economic perspective, I think the first choice for a stressed asset would be a haircut and to get the entity to survive. If need be, let the promoters move out. The last resort should be the formal bankruptcy process. And since the number of firms, small and large, which would be having an overhang of debt when times become normal, some special treatment would be required. The banks should start preparing themselves for it. It will require decision making at mid and junior levels across the country, a greater willingness to take risks and confidence to take commercial decisions and not play very safe, and some willingness on the part to also inject additional capital if required in some banks, because at the end of the day, there are no free lunches. So there is a cost the economy is bearing today for the lockdown and the slowdown. So down the road, somebody has to bear that cost, either we as taxpayers through the government budget or bank depositors. There are only two ways these costs can be borne. And hopefully the costs get minimized if the recovery is very robust and swift.
Absolutely. Dr. Pullarao, what's the best way forward?
Best way forward is government should be more liberal, RBI should be more liberal if we are ever to get over this COVID crisis, especially expansion of banking reaching the right people, banking reaching the farmers who have done a wonderful job during this period, and they're underbanked, as I said. So government should, along with all these reform processes mentioned by our panelists, government should also look into how to get the banking entities, the new design of banks, so that they answer the uniquely Indian situation, where there's a huge saving habit also. We're one of the biggest savers in the world, and yet we are not being rewarded with adequate banking and enough banking flexibility. We need a new thought about this. I don't mean disrupt everything. A little bit of disruption in the sector, maybe to go a long way to address the lacks, the scarcities, and other things. We're a huge country. We are not Switzerland or Austria, where there's one bank and, a tradition of money lending and all that. Therefore, I would look forward for some new ideas, some disruptive ideas in the banking sector, so that what you have said is reform will touch everyone in a very positive way. I don't mean throw away the money. I mean use it for all very carefully so that there are adequate returns for everyone.
Absolutely. All right. And Siddharth, close the show for us with your concluding remarks.
Well, I think banks need to reinvent themselves. They can't live in this 1970 kind of a mindset. You have seen the emergence of all these wallet companies. You've seen the emergence of, these various other tools of payments, and banks are clearly lagging. They are not investing sufficiently in technology to be ahead of, the trends that are there, both in terms of payments, in terms of savings, in terms of, overall credit behavior. So they need to reinvent themselves, shed this baggage of, in fact, not even 1970s. This is, going back to pre-independence era kind of banking. The focus is on still the same set of people, same set of tools. You need to move beyond that, and unless you do that, technology is going to steal away business from you, and you already, deposits are going to be scarce because the new generation doesn't keep fixed deposits. So they're much better off, keeping money in SIPs, etc. In any case, you're discouraging people from keeping money in FDs. Public sector banks are going to have already lost a lot of salary accounts, so the new salary accounts aren't coming to them, which is the fuel needed to lend. So these are challenges which they need to, wake up to and respond aggressively.
Absolutely. All right. On that note, then, we call it a wrap on this edition of The Big Picture. Thank you to all my guests for joining me on the program and putting things into perspective for us. What's coming out of this discussion is that reform should be undertaken as far as banks and the RBI is concerned so that banking can reach everyone. As far as banks are concerned, they need to reinvent themselves and think out of the box. We've done reasonably well as far as the pandemic is concerned. The banking sector has survived and is doing decently well. All we need is a little bit of fine-tuning, a little nimbleness on as far as the regulator and the banks are concerned. The RBI has played a great role of a regulator and done very well as compared to its peers across the world as well. All we need to see going forward is to ensure that we see a far more robust banking system that is abreast with the times. With that, it's a wrap. See you again next time.